Right. Good evening, everyone. Right. Okay. So in the last session, we were talking about mergers and acquisitions, and we went to a couple of areas. Starting with, we discussed about the difference between what is a merger and an acquisition, and what are the main reasons for mergers and acquisitions, and then what are the main steps of mergers and acquisitions. And then we discuss different scenarios of how are we going to calculate when there's a share exchange, when there is a cash exchange, how it will affect uh, for the shareholders, and from a perspective of the target company and also from the existing firm, how they perceive what would be the synergy effect, whether it's worthwhile to go for that merger, things like that. And then we discuss about the defense strategies. If an organization wants to take over another firm, there are two ways. We can do as a friendly bid or a hostile bid. If we go with the friendly bid, the things would be very straightforward. But if it is a hostile bid, where we take over the other firm without without their consent, the target company also have certain strategies which we called as the defense strategy. So we were discussing about different defense strategies in the business world. So moving on, let's do this particular question just to refresh where we are, and then we will do a couple of reasoning why mergers and acquisitions has been successful, and then why mergers and acquisitions have failed over the years, and for a company to be successful, what kind of major things that they need to ensure in a mergers and acquisition. And after that, I was thinking of doing a revision of what we have done so far, especially in the business valuation area. So, and then we will have another revision on all the areas of mergers and acquisition. So that's the plan. So today we will continue from there. So if we look at this particular question, uh, this is about another mergers and acquisition question. Let's quickly go through it and see how we can get the answers. Now there are two companies, IOC and Servo. IOC company has the board decided to use the market-based approach as the final value of the Servo and intend to acquire it. So what kind of steps that they need to follow in order to do so, and with the additional information below, they want you to analyze the effect of the acquisition if IOC believe that they can continue to enjoy the same price earning ratio. Now, starting to answer the first question, I want you to quickly jot down some points. What are the main steps that IOC need to follow if they are interested of taking over Servo? Okay, so I'll give you just 1 or 2 minutes to jot down the points that or steps that you can remember in order to make this take this forward. Yep, let's quickly make some points. We discussed it at the last session, the main steps, or we call this M&A process. Yeah, right. So the first step, before taking over another organization, first you need to identify your target organization. If IOC want to take over another firm, they need to really evaluate all the organizations in the industry, do a thorough check, do a SWOT analysis, all the tools and techniques to decide what is the best uh, company. So you need to do a thorough evaluation and you need to select your target firm. So this target firm uh, is basically discussed and decide that we are going to take over this firm. So it's already decided by the board that they are going to take over servo. So that's the first step where they have to decide what is our target company. Once you identify the target company, the next most important decision is you need to know what is the value of your target company, because if you don't know your value, you can't start this or initiate this process of taking over. So you need to know the value, and this is where we are learning all the steps or all the methods of business valuation. So in couple of sessions before, we learn how we are going to calculate a value to a business. We use three approaches: asset approach, the income approach, and um, the market approach. So that also they have given you some information that they have decided to use the market space approach for this organization. So just to check with you, if you use the market based approach, in your opinion, what would be the value for this organization based on the existing information? If they use the market approach, what would be the value of your target firm, that is servo? Yes? Yeah, what's the value? Yes? 2,400 million. See? Yeah. So how do we get it? So the market price is there. The market price is 24. So 24 we have the market price into the number of shares. You will get 2,400 million. So they have said we are using the market approach. So now ISC board have decided they are going to take over servo at $2,400 million. Now the next question is, so first we identify the target company, now we value the firm, there we use the market approach. The third one, how are we going to exchange this, or how are you going to settle, how are you going to take over the servo? And we learn there are three methods of taking over the target firm. Either you take the cash option, you pay the cash, in terms of cash you pay and then you take over the servo, or you can issue shares through a share exchange, or through uh, another instrument where we use either debenture or preference shares or loan stock in order to settle this amount. So first you need to identify your target company, then you need to evaluate and give a valuation for the company, and thirdly, how are you going to settle this amount? How are you going to take over? How are you going to finance that? So that's the main three steps that they need to follow. So now the next question, with the additional information below, analyze the effect of this acquisition if IOC believe that they can continue to enjoy the same PE ratio. So IOC PE ratio, as you can see, 10. Servo, the PE ratio is 6. So what they believe is, if IOC take over servo, they will enjoy the same PE ratio that IOC is currently uh, reporting. So if that is the case, you need to get the relevant information. So what is the acquisition, new acquisition, the post acquisition effect? Okay, because as the last step uh, of the first question, you need to identify that as well. After you acquire, what would be the financial effect? After the acquisition, whether the shareholders will be benefited. After the acquisition, what is the post integration plan of your business? So all this also has to be decided before you take over the firm. Then it will become successful, which we will discuss in detail later. So that's also the last step of that you need to follow. So in this particular question, what I want to know is they ask the effect of this acquisition. So what kind of effects that you need to identify? You can calculate the total earnings after the acquisition. You can calculate the total number of shares that IOC has to pay in order to take over Servo, and your new earnings per share, and then what is your expected new share price of this organization. So when it comes to post acquisition effect, finally what we want to know is when you take over Servo, what would be the price of the new company. So how are we going to do that? We did a similar question in the last class. So let's refresh and try to arrive the same methodology to get these values. So in order to IOC to take over Servo, we know the value, and after this acquisition, what would be the expected share price of IOC? That's the question. What would be the expected share price of IOC? Yeah, anyone to calculate what is the expected price of this share after the acquisition? That is the total, the new shares, expected share price. Yes, good. So let's quickly calculate this. Um, how are we going to get the answer? First, we need to know the total earnings of this firm when they took over Servo. So what we did was we had $1,000 million of earnings from the IOC and $400 million of Servo, which means the total as a combined entity you will get 1,400 million. And IOC has 200 million of shares and Servo has 100 million of shares. And also the earnings per shares are given, P ratio are given, share price also given. Now, we already identified the value of Servo is $2,400 million. So, in order to compensate by the shares of IOC, we need to find how much of shares that we need to basically issue. So, we have 2,400 million worth of company. If you divide by $50, you may find how many shares that we need to issue by IOC. How much is that? Yeah, so 48 million. It will be 48 million shares has to be issued by IOC. Now IOC already have 200 million. So therefore, the total IOC shares is going to be 248 million. Right? Now we know the total earnings is 1,400 million. That is total earnings, and total number of shares is 248 million. So we can calculate for a one share the post acquisition earnings per share would be, the post earning per share would be how much? 1,400 million divided by 248 million, 5.5 $5.65 per share. Now we need to calculate, okay fine, we got the earnings per share, and then they say that we are using the same PE of IOC. So this is where we did the bootstrapping theory, where we use the IOC the PE for the calculation. So we know our new EPS and we know the PE should be 10. So therefore PE is 10. The post acquisition earnings per share is 5.65. Based on that we can easily calculate what is the expected price of the share. So then you will get 56.5 dollars per share. So this is the post acquisition effect. Now let's discuss in this situation what would be the benefit for IOC. What would be the benefit for IOC? IOC existing shareholders, their share price was $50. Now with the acquisition, it is expected that share will increase to 56 0.4. So when you look at from an IOC shareholders point of view, existing or the old shareholders point of view, they will favor this acquisition. The reason is they are going to benefit. As a percentage, if you calculate, you can see 56.4. So you deduct 50, you will have a $6.4 saving. As a percentage of 50, it's more than 10% premium. So if you get a 10% premium for your share price, then the IOC shareholders will be favorable on this situation. As I told you, one of the critical success factors for a merger to be successful is the attraction and the getting the favoration from your existing shareholders and employees. If they are not happy, you can't proceed with this merger. So now you can see they tend to be benefited from that. And what about the servo shareholders point of view? What do you think? Servo shareholders, are they going to be benefited from this merger or not? How do we find it? For that, as I explained you in the last session, we need to know, okay, previously you know what is the value of servo, right? So what is the new value of servo shareholders? Now servo shareholders, how much of shares they are going to earn? 48 million shares. They are going to get 48 million shares. So if they are going to get 48 million shares, what is the new share of the firm? The old shareholders are going to get 48 million shares of servo. So what is the total value of the servo at the moment they had 2,400 million, but with the new acquisition 48 million into, we have calculated what is our expected share price, right? So from a servo's point of view, servo shareholders point of view, they are going to get 48 million shares, and the price of their shares going to be 5.65. What would be the value? 48 into 5.65. 200 and I'll use the microphone instead of this. Can you hear now? Okay, fine. So let's continue. So in the previous calculation, we said this servo has a value of 2,400 million, and with this new acquisition, it's going to be 2,712. So from a servo's shareholders' point of view, they are going to get a benefit of 2,712 minus 2,400. They're going to get a 312 million benefit. How do you do that? So these are the new prices. We said that 56.4 is the new share price. So we have 2,712 as the new value. The old value we calculated, that was 2,400. So therefore you are going to get a benefit of 312 million to the shareholders of servo. So therefore they will also, as if you look at as a percentage, you can even calculate as a percentage. 312 divide by 2,400, what would be the additional contribution that they will get from this merger? If you take as a percentage, you can say how much they are going to earn the additional income from this merger. So if you calculate as a percentage, how much? Yeah, 13%. So you can see all the servo shareholders get a premium of 13% from this merger. Previously we calculate for the IOC shareholders also. The share price initially was 50 and new price was 56. So if we calculate that difference as a percentage, 6.4 divided by 50, even the servo share, the IOC shareholders also getting a 12.8% premium from this merger. Now you can see this is a win-win situation. Now because of this merger, both the shareholders are going to get a benefit. So therefore they will favor on this merger. Now this is very important in mergers and acquisitions. Who is going to enjoy the benefit? So if you go for this kind of a deal, the servo also favor and IOC also can easily get the benefit. So in this case actually servo benefit more than IOC, because the main reason that IOC believe that they can use the game theory for this acquisition, failing which it will impact the entire merger to be failed if they are unable to achieve it. So this is just to give you an idea, just to refresh what we discussed in the last session also, mergers and acquisitions. Always you need to follow these steps, starting with identifying the target company, then you have to do a proper evaluation and get a valuation, and based on the valuation then you need to decide what is the mode of payment, what kind of so you need to know the advantages and disadvantages, all these options, and then finally you need to have a strategy. How are you going to achieve your expected benefits? Okay, so with that we will move on to the next area. We already discussed the defense strategies in the last session. I'm not going to repeat them. If you can remember, we discussed about poison pills, white knight bidders, management buyouts, stagger board, trigger acceleration of debt repayments, litigation. So these are some of the defense strategies that are used in order to overcome a hostile bid. But however, there are many different techniques are already developing at the moment, because when the hostile bids are coming, sometimes you can't use the same existing defense strategies, because the companies are knowing that the target company will go for these options, so they also have strategies to overcome. So therefore, new strategies are developing every time when every time these acquisitions are happening in the world. So moving on, we discussed about some mergers and acquisitions happen in Sri Lanka, and then we move, as we discussed, why mergers and acquisitions fail. What is the reason? Because it is believed, even we find hundreds and thousands of mergers acquisitions happen in the world, we also see that hundreds and thousands mergers are failing. So this is a very important area to understand why mergers and acquisitions fail. There was a survey, and based on this survey I have presented these details. From these percentages you would have seen the main point. 85% believe that mergers and acquisitions fail because the target management attitude and cultural differences. If you can see now, this is a more related to HR, because even though you find best synergies of getting together, even if you find best marketing opportunities of getting together, or whether you will get many profits or you will have many other advantages, if they are culturally different, there's a high chance that the two companies are going to fail. As I told you, these are corporate marriages, right? So probably these are the same examples or the factors leads the marriage to be failed. The target management attitude and cultural differences. If one company or one entity has a set of attitudes and it is going to be different to the others, this conflict may lead to a failure. If company A and B are merging together, and if A think that they are superior, they are strong, they are the leader, and B has to listen all what A says, where B is not in that mindset, B do not believe that A is the main leader, or that the B should follow what A is trying to tell. This the mentality may leads a failure, because when they are trying to take business decisions, company A might try to overtake company B's management. So then there will be conflicts. So therefore they say the management attitude plays a major role in the successfulness of these mergers and acquisitions. Also the cultural differences. It can be due to two nations. It can be due to, like, if you take an example, if a foreign company come to Sri Lanka and they taking over a local firm, and the management is going to be foreign management, there may be cultural difference between the management and the next level employees. So therefore it will not be really understanding each other, and that may leads to a failure of this acquisition. It may be from country to country, or even from region to a region, or it may be even the majority of the target company are in a different religion, or a different ethnic group, or it can be a different caste. This will link to cultural difference, which will fail the arrangement. And the next important option is little or no post-acquisition planning. Now, this is a very important point. Now, most of the organizations, they will do all the strategies to take over the firm, and there's no such plan after the takeover. How are you going to live? So until the marriage, everything they plan, but after that they don't have a plan. How are they going to continue it? This has led to a failure in mergers and acquisitions, because they may do all the strategies only to take over. But after an acquisition, there are so many things to plan. If you take an example, if A and B are the two firms, when A acquire B, they need to have a plan. How are you going to share the resources? How are you going to share the management decisions, or the ownership, the locations, the brands, and the staff, and what kind of the strategy that they need to, what kind of products that they are going to get rid of, what kind of cost they are going to save, and how they are going to save. All these has to be calculated and decided before they go for this acquisition. And if there's no such plan, then what happens is after they acquire, they start setting up the plans. This will link to a disaster. Then people will start fighting, and they will have conflict of their interest and opinions, which will lead to a failure of what they set up. Another important thing is lack of knowledge of industry or target. Now this is a very, again, a common reason for a failure. If you take an example, if A is going to decide to take over B, where A does not know about B at all. Now, B may be probably in a different industry. Let's say A is in the construction industry, but B is in the finance industry, banking industry. So this company A doesn't have an idea of how the industry of B works. What are the main traits? What are the attributes? What are the constraints of this industry? What are the critical success factors of the industry? Whether the company A has the knowledge and the power to control this, whether they have the management expertise to handle the situations. So if they don't have such knowledge or business know-how, the moment, even though you take over, you know that you are not going to be successful, because they don't know what is this target industry is all about. And this may lead to a failure. Sometimes if they give the right autonomy to the target management and to run, things might change. But if they're going to take over the control of target company and then they don't know how to operate it, it's going to be a failure. So lack of knowledge of industry or the target. Another important factor is poor management and management practices. Now this is lead to the previous ones as well, but poor management means if A is going to take over B, and A management skills or the knowledge of how they are going to integrate with the new firm is less, then it will impact to fail this merger and acquisition. Now if you take an example, some companies they have a proper plan. They set up they do a change management exercises. They train the people. They give the right leadership in order to work as a team. But if the management is not aware of how to do that, then what happens? It will intend to a failure because they don't know how to handle for a with the new organization. And the last but not least, little or no experience of acquisition. Now, sometimes some organizations are very fond of going for mergers and acquisitions. Their business always expand through acquisitions. So they are experience of how to handle acquisitions and mergers, how they can overcome the issues, they know because they have an experience. But some organizations, that may be their first acquisition or the merger. If that is the situation, then you are not experienced for a new arrangement. You don't know the things that to be considered, things has to be watched when you are going to be when you are going to be merged or takeover. So that may lead to again failing. That's one reason. But the main reasons, as we discussed at the beginning, the change of the management attitude, cultural differences, no proper planning after the acquisition, no understanding about the industry or the target, and poor management practices. So it is now there are many other factors, but these are the main ones. It is believed why M&As are failing. But the good thing that why we need to know this, because when we are going for a merger and acquisition, we can be, we know that these are the things that it can go wrong. So we have to be extra careful of avoiding such issues from your new arrangement. So to be more positive, how can we become successful? So we know the things that the pitfalls that we may fall, but how are we going to be successful in mergers and acquisitions? Now this is again a survey done by a group of companies who have been really benefited from mergers and acquisitions, who have really grown their business from mergers and acquisitions. So based on that, what they believe, the first most important point, a detailed post-acquisition plan and speed of implementation. Detailed post-acquisition plans and speed of implementation. I know companies like Unilever's, when they have these acquisitions, they have a detailed post-acquisition plan. They know exactly how are we going to be changed. What would be the new positions? What is the new hierarchy or the organizational structure of the, now A may have a previous organizational structure. B also have a organizational structure. But when they became together, what would be the new organizational structure? What are the new positions going to be created? And what are the positions that has to be get rid of? And what kind of people, some people may have to they have to be changed to different departments. Some may have to be laid out. So we need to have a proper structure. So every employee in your organization should have a plan after the acquisition, what is going to happen to you. What is your new roles and responsibilities? If you don't know that, then employees will create issues. They will have a fear of this um, merger because it will impact, it will threaten their job. So every single person has to be clear and brief what is going to be your new role. So that's from an employee's point of view. And then from resources point of view, let's say there are two, let's say these mergers are with two banks, A and B. A also have a particular branch in a particular town. Let's say Candy Town, Bank A also have a branch. In the same town, Bank B also have a branch. So they need to decide whether they are going to continue with these two branches or they are going to combine and having a one branch and taking the closing down a one location, and if that's the case, which branch they are going to close down. Everything has to be planned. And how would be the new advertising campaigns, what kind of brands that they are going to, are they going to change and come up with a new brand, or whether they are going to continue with their old brands. Like now, if you take an example, Glaxo and Smith line, when they get together, they change their brand name and their products went as Glaxo and Smith line. So when it Aviva and Sri Lankan operation, Aviva and NDB, when they get together, they went Aviva NDB as their brand name. So how it's going to be their brand name? What is the management structure? What kind of positions? And all the how they are going to, okay, if they have taken any particular loans, how they are going to settle it? What are the additional costs they are expecting from this? If they are going to give any VRSs, who are the people they are going to give the VRS, how much they are going to be paid. Everything has to be very clear and explained. And then the next one, clear purpose of making acquisition. This is another important thing. As I told you, sometimes companies take over the others, but they don't have a clear idea why you need to take over the firm. This is where, when I'm explaining about IOC and servo, one of the first things that you need to decide is that your target company. So when you are deciding your target company, you have to be very clear why you are taking over this firm. What is your main purpose? Because if you don't have a clear purpose, then the moment you acquire the firm, still you are not sure why you are acquired this firm. What is the benefit of this? How am I going to be benefit? So if you are not clear about that, then you will not be able to success. So that's why all successful mergers and acquisitions had a clear purpose. So the moment they acquire, they will work to achieve that purpose. The third point, which was a weakness in the previous one, a good culture fit. Now this is very important for a successful corporate marriage, because if you are culturally fit, if your management have the same attitude, if both the management have the same understanding with each other, they have a good cultural fit that really leads to have a success in M&A. Also, high degree of management cooperation. Now this is also very important. Now you need to understand, it's like two different worlds. If when A has set up and developed and come to a certain level and they have certain practices that they used to follow. B also coming from another purpose, and then they have built and they have brought up and in a different management style. So when these two organizations are going to be get together, you need to have an understanding and a cooperation. You need to understand there are some management decisions has to be sacrificed by the other management, or A company management decisions may not sometimes favor the management of B. So you may have to compromise and come to a negotiation. So this is where the cooperation is needed. If one management of A is adamant that they need to take this decision and they are not letting the others to go ahead, this is going to be fail. So one of the main success is, even your cultural fit, even you have a proper plan, you need to have a lot of cooperation. If both the parties should be ready to listen, ready to be flexible. If it is the case, then they will be successful. The last but not least, again, the in-depth knowledge of the acquiry of the industry and the industry. Now, this is all linked to the previous ones as well, but before, as I told you, before we take over, you need to have a thorough understanding about this acquiry. Because if you don't understand, or if you don't have information about that, or even the industry, then the chances are it's not going to be successful. So if it is in the same industry, it will be more favorable because you know about your industry and you are going to take over another member in the same industry. So you know your main things to work. On the same time, if you are thinking of another industry, you need to understand and have the business know how to manage that organization. So if it is a case, then you can be successful. Especially you see some organizations are diversified. They are into many sectors, but they will perform well because they have the right talent to manage different industries. So if you have that, then there's always a chance to become successful. So therefore, in order to be successful and in order not to be fail, you need to have these three important points in mergers and acquisitions. So these three important points will make you a successful merger and acquisition, and you will enjoy the expected benefits or synergy that you intend to achieve at the time of deciding to take over this firm. So the first one, as I explained, you need to have a right strategy. This strategy is very important. If you don't have a strategy, do not try to take over another firm. Do not even think about it, because ultimately it will fail and you are going to lose your reputation and you may lose the resources as well. So this right strategy will lead to achieve your expected results. And it has to be realistic and not to be over optimism. Now, why I said that? Now, sometimes in the previous questions, if you can remember, we believe, now IOC and servo example also, we believe that the IOC can continue to have the same PE ratio to servo as well. So you need to think whether it's realistic, whether you can do it. Probably some in a long term, but not in a short term, because immediately you can't change the other company. You cannot uh, take on all the weaknesses of the your target firm. So you need to really sit and think whether is it realistic that the goal is, because otherwise when your expected results did not turn up, it will impact your share price. So you should not be over optimism on your expected results. And the last and the most important thing is the strong integration management. So keep in mind, this will be tested in your exams also when it comes to mergers and acquisitions. Why they fail, why they become successful, and if they want to be successful, how they are going to, what kind of things that the management should do. So strong integration management means there should be a plan, there should be a strategy to on how are you going to manage your post acquisition. As I told you, how are you going to share your resources? What is going to be your new organizational structure? What is your hierarchies? Who are these positions? How are you going to fill? How many percentage from your existing management will be taking over? How much of percentage that we are giving for the previous management of the target company? And everything has to be very clear, and there should be an integration plan, integration management. Especially there should be a proper change management techniques, trainings and workshops to handle this situation. If they do it, then definitely they will be in a better position of taking over the new firm. Right. So so in this, we'll have a quick break, and then what we are trying to do is we will be going in detail of what we discuss on the business valuation, all the areas as a revision area, because this will be actually a revision of what you discuss on the business valuation before your finals, and then closer to the exams I will do another session on business the acquisitions and mergers area as well, with some more questions, right? So after the session I will go through about the business valuation and a summary of what we discussed so far. Right. What I'll do is in the next few minutes is to revising of what we discussed in the last couple of sessions about business valuation. Now, starting with, we learned there are many definitions on business valuation. There are many definitions of business valuation. And when it comes to business valuation, the core idea of business valuation to understand or to arrive a fundamental value to a business. In other words, to understand or determine the intrinsic value to a business. Because we learned that there are many ways to derive a value for a business, and what we are trying to achieve is to arrive an intrinsic value to a business. So when it comes to definitions, there are quite a lot of definitions we can find in literature. If I give you a couple of them which I have shown in the slide for your reference, and if I emphasize on the second one, the alternative definition, business valuation is a logical, defendable process of arriving at the opinion as to the worth of a business given the information available, assumption and limiting conditions as on the value date. So very simply, we are trying to give a value in a more logical and a defendable way based on the available information, assumptions, conditions and limitation. There are many thoughts on business valuation, starting with, they say it's an art, it's not a science. It's very subjective than objective, and it is how you perceive things, and it's depending on your valuer and based on their skills. And the valuation will change from time to time, and it is how you see, and it is very important for decision making, and it's an application of theory and practice. Moving on, how are we going to give a value to a firm? It's not that straightforward, because we know there are so many things to consider. We discuss, if you are trying to give a value, we need to understand how much of assets they have, what is the image of the business, how is the employability and how much of staff involved in this organization, what is their biggest strengths, what are their any intangible resources that they have, so on and so forth. So we consider a list of factors such as their nature, history, and the economic conditions as at now, the industry
norms or industry trends, and the book value of the assets, the earnings capacity, and the dividend paying capacity, tangible and intangible values, and the market prices, and so on and so forth. So there are hundreds of factors affecting the value of the business. Next, we said why we need to value a business. If you can remember, we were trying to answer 3 questions in this business valuation session. 1, what is all about business valuation, which we just discussed. And the next main question was why we need to value a business. So as you can see, we list down many reasons a firm why they are going for another business valuation. And couple of these factors are to purchase a business, business sale, mergers and acquisitions, restructuring, leverage buyout, management buyouts, initial public offer, employee share option schemes, when you buy back your shares, even to finance a particular project, or even at a time of your closing down your business, bankruptcy, and valuation of court cases, valuation for compliances, fair value accounting and tax issues, and even at strategic planning level, we do business valuation. So mainly when you are buying or selling a business, even you are changing your structure, restructuring. If you are going for a loan to take over the firm, if your own management is going to buy your firm, when you are trying to issue your shares to the public or to your employees, taking shares from the stock exchange back to your firm. So many reasons to value a business. So then we need to know how are we going to value a business? Well, in a broad context, we have 3 ways to value a business. There are mainly 3 ways to value a business. First, asset approach. Second one, the income approach. Finally, market approach. We also believe that there are many factors affecting these 3 approaches. Sometimes asset approach would be better than the other 2, where sometimes income or sometimes market approach will supersede the other 2. So there's no best option or method. It will change based on the scenario and how the factors are influencing the organization. So starting with asset approach. In a very simple context, we are trying to get the value of the asset to arrive the value of the business. It is the most easiest and in terms of understanding, even calculating as the method of valuation. When it comes to asset approach, there are 2 ways of valuing the asset approach. One is to historical values or to using the fair values. Historical values is where we take the values which are stated in the financial statements. Fair value is where we take the valuation of each and every asset and a liability and then arrive the net value of the business. We need to remember that this asset approach is not only looking after the total assets but the net assets. What do you really mean by net assets? From the total assets you deduct the total liabilities and then you arrive the net assets. So this net assets is equal to actually the shareholders' value of the business, the true ownership of the business, the amount which is owned by the equity holders of the firm. Because if you look at the accounting equation, we used to have the same one where we know that total assets is funded by two ways, that is through capital and through debt. So net assets means from your total assets available, when you take out all your debt, what you remaining. So it's very simply net assets means C. So A, total assets minus total liabilities, is C, that is your net assets value of the business. And the second approach that we are using is the income approach, where we trying to understand the future cash flows of the business and to arrive the value of the business. So we are using two mechanisms, that is discounting and capitalization. Next we were discussing about the market approach. Market approach is trying to give the value based on market forces of a country. And it's very easy to find if you have a readily available price in the market. So we have two types of businesses. The businesses you have a readily available price, the businesses does not have a readily available price. So we follow two approaches in order to arrive the value based on whether they are listed or not. So let's move on to the asset approach. So here we take the, as I told you, we take the fair value or the historical value of assets and liabilities of a business, and so that we can arrive the asset approach. So we look at a balance sheet. This is how it looks like. The total assets would show in this side. The total liabilities will be showing in this section. So when you take out these liabilities, what is remaining is your net assets. In other words, that is the equity of your firm. So how do we arrive in a more detailed manner? If you see this calculation where you have the total fixed assets, total current assets, you take out the short-term and long-term liabilities of your firm and you arrive the net assets. So these net assets in this firm is 3,147 million pounds. And this is equal to total equity value of the firm, that is the shareholders and the minority interest total, which is going to be 3,147 million pounds. So this is to give you an idea about different companies listed in London Stock Exchange, where they have present the net asset value and the market capitalization. Now this is very important even for your assignment, where the company that you select, you can show the NAV and the market capitalization. Even your competitor that you select, you can show the NAV and the market capitalization. So you can compare and give recommendations on your assignment whether your selected company is a prospective investment company or not. Having said, looking at the companies which is listed here, you find Vodafone, Unilever. For Vodafone, the net asset value is very high than the market capitalization. On the same time, the Unilever, the net asset value is less compared to the market capitalization. Ideal speaking, it should be higher. The market value should be higher than the asset value, because we know theoretically net asset value will represent the value of the existing assets and the liabilities. So it does not consider any future value. But market capitalization will represent not only the existing value but the future value that the people may expect, or they believe the value of the firm. So the main advantages of this method is it's easy to understand and easy to calculate. On the same time, if a firm has a lot of tangible assets, especially companies like construction firms, companies like manufacturing firms, has a huge capital intensive assets, will represent a better value for such methods because it has lot of assets, and the net asset value will represent the real value. But on the same time, if a firm has a lot of intangible assets, it should not be a wise decision to use the net asset approach. And finally, it shows the minimum value of the firm. As I told you, minimum value represent the value which do not have a future cash flows, which you do not see a potential value. So it is the lowest value if you are thinking of bidding a firm. In the bidding process actually start from the net asset value. That's the value that you can sell all your assets and settle your liabilities and what you can get for your hand. So in the bidding process, this is very important. The price to start. So the disadvantages, if it is a fair value method, of course it's going to be difficult and it's not easy and reliable because you need to value every single asset and a liability. On the same time, when the assets are intangible, net asset value may not show a realistic value in the business, especially for software companies, companies which has lot of patent copyrights and lot of intangible assets. Some software firms today are totally on internet. They are all virtual. They don't have physical assets. They hardly have buildings. They have their servers, their main data, everything on a cloud. So therefore, such organizations is very difficult to give a quantifying a value, and it may be difficult for them to even go for a bank loan, where the traditional banks are very concerned about the collaterals. When you don't have physical assets, it may be difficult for you to finance your business. And on the same time, these informations are subject for accounting manipulations because you are getting these data from financial statements, especially the historical value of net assets method. And it will be subject to depreciations. It will subject for different calculations and methods of depreciation and valuing business tangible fixed intangible methods. So because of these manipulations, you may not be able to get the right value of the business. Then we move to the income approach. Income approach actually more advanced and accepted than the net asset value method because it considers the future cash flows of the business. So here what we do is we identify the future cash flows of the business and see the present value of those future cash flows and then try to understand the value of the business. In income approach, we have mainly two types or two models, that is the Gordon dividend growth model and the discounted cash flow method. So starting with Gordon dividend growth model, the inventor of this approach is Gordon, that's why it says Gordon's dividend growth model. This model trying to understand the dividends payment pattern of an organization and trying to give a value based on that. So when you are trying to understand the dividend pattern, you find there are three types of patterns. One, you have a constant dividend, and sometimes constant growth. We have a dividend with a constant growth. Also, there is no consistency. The growth is non-constant. So three arrangements. One, it is fixed and constant, or constant with a growth, constant dividend with a growth, plus constant without a growth. So for these three approaches, the valuations also made three ways. Starting with, how are we going to give a value for a firm when they pay constant dividends? I'll take you through this example as per this question. If a firm is expected to pay a dividend of 20 pence per year to indefinity, and the rate of return required for the share is 12%. How should we get the value? In a very simple context, if you look at, it gives you the equation here. This is based on annuity in mathematical calculations. We treat it as an annuity where we believe the dividend will be paying forever for infinity. And the annuity we take, instead of the interest rate, we take the risk rate. In other words, the cost of equity of the firm. Then we will arrive the share price of the firm, which is 166.67 pence. Now, what it simply says is, if the firm is paying 20 pence per annum forever, if you discount all the cash flows from year 1 to infinity at a discount rate of 12%, the total value of the present, or total value, or total of all these cash flows, present value would be 166.67 pence. Now we move on to a situation where you have a dividend with a growth. Now in the reality, you cannot expect a fixed dividend forever. So sometimes when the firms are growing, the dividend also will grow. For with that assumption, we'll try to think about a situation where if a firm has a growth on its dividend, the equation will be slightly changed. Now previously you find D1 divided by KE. Now we have the growth rate, so we find the D0, that is dividends paid for this particular year, and we use the growth rate to arrive the dividends in 1 year's time, that is D1. Now in the previous calculation, yes, we have D1, but there was no difference between D0 and D1 because we believe the dividend amount is constant. But when the dividend is non-constant, if it is having a growth, what you pay this year is not the same for next year. So therefore we need the D1. So what we do is we take the dividends today with the growth rate D0 into 1 plus G and arrive D1. And that we divide by KE minus G, so that we can calculate the value of the business by using the formula, and then you will arrive, if it is the case, your share price is going to be 2.67 pounds, or in other words 267.5 pence. Now it's different to the previous one because the amount the previous case the dividend is constant, but here you have a growth. So when you have a growth, obviously the value that you are expecting is also higher than the previous method. Now let's move on to a situation where you have not been given the growth rate like you get it in your assignment. You need to find the dividends per share for the last at least 5 years and to arrive the growth rate. The higher you take the years, it will represent a better growth rate, because now in realistically when you are doing your calculations, you would have realized there are outliers. There are some years you have not paid dividends. There are some years you have got negative earnings per shares. So if you are trying to really get the dividends growth rate, you need to have a good sample of dividends per share and then apply to the equation. So in this particular equation, how do you interpret? You take the number of steps as in, how do you arrive this? Because it's the growth rate. So normally you can easily calculate this from the total number of years. If you deduct 1, you will get the number of steps. And then D maximum is the highest dividend that you pay during your data set, and the minimum dividend that you pay during that time range. So from your data set, the highest dividends and the lowest dividend you will be derived and include for this formula, and the total amount you deduct 1, you will arrive the growth rate of your dividends over the period, and that is the rate that you are using for this particular equation when you don't have the growth rate given in a question. So based on that, you calculate the growth rate. So when it comes to dividends per share, you take the latest dividend, that is D0. But when we want D1, we convert this D0 into 1 plus G and then divide by KE minus G to arrive the price of the firm. Now we move on to a situation where we do not have a constant growth rate. Now this is very important because this has more calculations than the first two. So here if you look at this particular question, let me quickly read out. Company N PLC has paid an annual dividend of 15 pence per share for the next year, and then for the next 3 years they expect a dividends to grow at 12%. So they are paying 15 pence of dividend for the for the next annual dividend, and then they are expected to grow at 12%. The important thing is after the third year they are expecting the growth to be reduced to 7%, and they are going to discount at 16%. So how are you going to do that? First, we need to break this entire period into 2 sections. This is where this is infinity, this is today. So from today to first 3 years, you will have a 15 pen dividend with a growth rate of 12%. So you need to calculate the expected dividends in the next 3 years. So D1 would be 15 pence into 1 plus 0.12. This is the growth rate of the dividend. This is R, 1 plus R. So it's going to be 16.8. In year 2, it will be twice. Therefore, it's going to be 1 plus r to the power 2. So D2 would be 18.8. In other words, 16.8 into 1.12. So if we go with the same rate in third year, we expect the dividend to be paid is 21.1. So what we did was we calculate the D1, D2, D3 in for the next 3 years, what would be the dividends value, and thereafter it will grow at 7%. So we will apply this calculation for the first 3 years separately and from year 3 onwards separately. Now if you look at year 3 onwards separately, it is growing at a constant rate. So this is where we apply the same equation like the previous one, this equation. But for these 3 years you cannot apply because they are only for first 3 years. So then what we need to do is we need to get the present value of D1, D2, D3 separately. How are we going to do that? We take the discounting factor and redeem. Having 16.8 in year 1 is equal to how much today? Having 18.8 in year 2 is equal to how much today? Having 21.1 in year 3 is how much today? So how are we going to discount? This is where we apply the time value equation, that is future value is equal to present value 1 plus r to the power n. So here future value is 16.8. What we want is present value. R, is it given? R is given, that is the rate, that is 16%. N is the number of years, so that's going to be 1. So we need to calculate one by one the present value of these 3. So we arrive the present value of the first 3 years, and then we arrive the present value of from third year onward. And then we add these 3 figures to this figure and arrive the total present value of the firm as at today. So let's continue. So what we have done, as we discussed, we calculate the values of D1, D2 and D3 in today's terms. So 16.8 you divide by 1.16 into 1 year. Like that you discount for all 3. So here is the same thing. There are 16.8 divided by 1.16. For year 2 you divide 18.8 divided by 1.16 to the power 2 because it's year 2. Here you take the year 3 figure of 21.1 divided by 1.16 to the power 3 and get the present values. How are we going to take the present value of this? What we do is we use the equation, that is D1 KE minus G. Now what is D0 for here? Keep in mind we are trying to do the calculation starting from here. So D0 means what is there at here. When you look at from year 0's point of view, this is end of year 3. So end of year 3 is your D0 is 21.1. This is year 1, this is year 2, this is 21.1. What we want is not D0, we want D1. That is 21.1 is D0. We know the growth rate is 7%. We can apply this equation. That is, we take 21.1 as D0 growth rate. That is, in other words, the 4th year's dividend. So you take the dividend today, that is year 3 dividend, and take the growth rate, divide by KE. They have given 16%. It's given expected return is 16%. Return for the shareholders, KE. So we put the growth rate as it is. Now in this case we can easily do it because the growth rate is less than cost of equity. So when you apply, you will get an answer of 250. Now you have to be careful. You can't just add 250 here. Why? This 250.9 is the value as at this point, not here. Because you start the calculation from here, and what you get as today's value is actually year 3 value. When you apply to the equation, you arrive this value of 250 is as at this point, because here we take D0 as year 3 figure. So the answer also you will get at the value at the end of year 3. So what we want is today's value. So what we do is we discount it and arrive the today's value. So how do you rediscount it? Whatever the value you arrive, you further discount by 1.16 to the power 3. Why? Because you get the year 3 value that you convert into today's value, and then you get the right value as 160.7. So having 250.93 in year 3 is equal to having 160.7 today. Now we have all today's values. So when you add everything, this is the value of your firm, and then you will arrive 220.7 pence as the present value of all the future cash flows of the organization. So this is a bit different to the first two because it has cash flows with a constant growth rate, a certain rate, and then change it to another rate after that. So you have to be careful when you are arriving the numbers when you have two growth rates. Fine. So these are the mainly 3 methods to value using the dividend growth model, especially when the dividend models are different: constant, non-constant, and dividend growth. But we have its own issues. I want you to discuss these points even at your assignment. What are the main issues that you face at the dividend growth model? 1. Yes, we are determining a growth rate, but it's a very, very ambiguous growth rate. You have to do some assumptions to arrive this growth rate, and those assumptions has led to its own reliability issue, or the weakness, or whether we can really take that value for the calculation. And if your firm is not paying any dividends, it's going to be an issue. And we have come across sometimes the company has paid dividends, but their earnings are minus. They have not made a profit for the year. But here the assumption is whatever the profit that the company have has to be paid in terms of dividends. And if you not have paid, if you not have earned anything, you cannot pay dividends. So it's against the financial management rules. But some organizations that you have selected have violated. So when they have losses, still they have paid dividends. Sometimes just to maintain the shareholder confidence and to avoid any signaling impacts on your share market. Having said that, when you are doing the calculations, if the company has not paid dividends, unfortunately you cannot arrive the dividend growth model. So that's one of the conditions in your assignment. The companies that you have selected should have paid dividends for the last 5 years. Next question is the main issue is the model calculation. The formula itself has some weaknesses, especially when the growth rate is higher than the cost of capital. We will have some practical issues where, because it's a mathematical calculation, the answer is going to be a minus figure, which does not make sense in a business. So therefore, if a situation where the growth rate is higher than the cost of equity, you will not be able to go ahead with the dividend growth model. But you can use assumptions where you can derive a growth rate which is lower than the cost of equity. And if your firm sales value is very high, then you can think even their profitability growth, even the industry growth, or even the competitors growth, or even the countries or sector growth, or even the economy growth of that particular quota, and to see how you can try to get a value for dividend growth model. At the same time, you may have to justify your points and arrive it. But if a firm is having a very high growth, especially when they started at an early stage, and when the company performance is really good, you may have this situation. So therefore, you need to find the right information and you need to get the right assumption in order to get the dividend growth value for a business. So we already discussed if the growth rate exceeding cost of equity, what kind of alternatives that you can think of. So with that information, let's try to do a quick question to cover these areas. So far we have done the dividend growth model and the net asset value method. So this is a company that we have selected. We discussed this question just to refresh. There are two companies, IOC and Servo. IOC is going to would like to take over the company Servo, and the Servo details are given. And if you are the manager of IOC, you need to give a price to take over this firm. If you look at the information, you have fixed assets, current the total liabilities of the firm, the PE ratio, earnings per share, number of shares issued, cost of capital. Plus, you have given some dividends per share information. So, let's quickly calculate the net asset value, then the dividend growth model of the business, and see what is the possible value range to bid this firm. So the net asset value would be total fixed assets is 3450, total current assets is 1700. So you can take the total assets of the business and deduct the total liabilities. What is the net asset value, please? 3000. You will get 3650 as your net asset value. And when we apply the dividend growth model, as you can remember, in this particular question, the growth rate is not given. So you need to calculate the growth rate. So if you look at the years, we have from 2009 to 2013. And the dividend per share is given for each year. So calculate the growth, please. What is N here? The N is so if you take the number of years from 2009 to 2013, you have 5 years. So therefore a total number of years minus 1, it's going to be 4. So the highest value of the highest dividends per share is 14 and the lowest dividend share is 10. And when you resolve this particular answer and deduct 1, you will get the growth rate as 8.8%. Okay, so based on your answer, we will try to see 8.8%. Okay, fine. So now let's calculate the D1. So D1 is actually now, as at now, you have paid $14. So that is 2013. So D1 is 1 year after that. So 14 is D0. You put the growth rate 1.088. That's D1. Divide by KE. Cost of equity is given because we need to take the cost of capital instead of that. And the growth rate remains same, that is 0.088. Right, so when you resolve it, you will get the dividend growth model value of the firm. And then we multiply the number of shares of 70 million. Then you can calculate the expected value of the firm based on this approach. Yes? How much? So $14 per share multiply by 1.088, it's gonna be 15.232. So 15.232 0.2 minus 0.08 0.112 0.12 is the 0.12 11.2, right? So divide by, so you have 136. Is it 9520? So once you resolve this, you will get the share price is as 136. Sorry? Yeah, 136 is for one share. And when you multiply by 70 million shares, you will arrive the value of the firm as 9520 million. So based on the dividend growth model, you can arrive 9520 million. Right, 9520 million. Net asset value is much more less than that, but that's okay. So based on that. So the range is starting from your net asset value to 9520 because we have only used the net asset value and the dividend growth model as at now. So we'll move on to the next area is the discounted cash flow method. Keep in mind in this method we did not go for a long calculation, but what we are trying to do is we are using the accounting profit and converting into the cash profit of the business, and then we discount it using a discount rate and to arrive the value of the firm. So we did an adjustment like this where we start from pre-tax pre-interest profit and did some adjustments. So because your accounting profit do not have any cash, certain cash adjustments, so you take away like things like depreciation we have been recorded in the pre-tax pre-interest profit. So we have already deduct this figure, so you need to add back the non-cash reductions. It can be accounting profits, accounting losses, it can be depreciation, things like that, and then you adjust it. And the capital expenditures normally you do not record in income statement, so we need to adjust that as well. And another important thing is the working capital adjustment. Now working capital adjustments we have been we discuss in detail. When the current assets, current liabilities are changing, there will be an impact to the working capital, so we do the adjustments accordingly. It can be minus or plus. Then we do the tax adjustments, which normally we pay and then we deduct to arrive the cash profit, and the interest payments since we have the pre-interest profit. And finally all the cash flows we will discount at the present to arrive the present values. In this particular question we went through that all the adjustments are done, and then we arrive the cash flows at the end, and those cash flows we use the discount rate and convert into present values. So this is the cash flow method which I did not put it as a requirement for your assignment, right? So but this is the one method of valuing the business, but it has a lot of accounting adjustments and many complicated calculations to arrive your value of the business. In here if you look at, we have calculated the value for each and every predicted cash profit, but finally we believe in this particular question that you will get a 14 pence of cash flow forever. So therefore we have used the annuity factor, arrive the present value of those future cash flows, and then rediscount it at 14% into year 5 and convert into today's value. So that's where we take all the cash flows into today's value and got 81.3 pence as the value. So from the discounted cash flow approach, we take the future cash flows into picture and arrive the value of the firm. So we further discuss about discount rate, where we need to calculate in any business we use the weighted average cost of capital to discount the project. When it comes to weighted average cost of capital, we need to know that there are three forms of arriving the cost of capital, that is cost of equity, cost of debt, and cost of preference shares. So we start with cost of equity, where we can calculate the cost of equity by two ways. One is by using the dividend growth model. The other method that we use the capital asset pricing model to arrive the KE. So once we get the KE, then we can put the weightage of equity and arrive the cost of equity. So we did a sum which I'm not going to go into detail. So we'll use the capital asset pricing model even for your assignment, where we take the risk-free rate which I have given. We take the market rate of the country again which I have given, but I want you to get the beta factor of the firm. So this will be readily available. And also the most important thing is, when you take a beta value, you need to show the source, because these beta values are also changing time to time and day by day. So always from wherever you get the data, you need to take a screenshot of that and attach in your appendix. The share price and the beta values are changing. So when you take those prices or values, you need to take a screenshot of your amounts and show as your proof in your appendix. So when you're writing the report, always refer that, and then it is easy and it's very clear how you take it, because otherwise we have a reliability issue. So that's why we need to prove that on this day at this time this is the market price, for this day this is the beta value. Right, so we have a lot of advantages in the income approach. The biggest advantage is we concern the future cash flows of the business. But on the same time, we discuss there are many disadvantages of this approach, because it accounts for a lot of assumptions which is not realistic and not practical. As a result, we have a question of your final value. Now, even in your report, I would really want you to do a simple analysis of all these methods at the discussion. The figures that you arrive, what are their main advantages and disadvantages. You can refer these slides, as well as you can go out of your way to find some information about the real disadvantages and advantages. So here in income approach, it is very controversial numbers. The discount rates are hypothetical, so therefore the audience may be confused sometimes how they arrive the number. So this is another question that we have already done, but I can allow you to practice again the answers I have given before. Here what I want you to do is to arrive the value of the firm by using the three approaches. So you have a couple of information here. What I want you to do is to arrive the do the adjustment. So you can apply the slide that I have shown you before for you to arrive this thing, and the cash profit convert into discounted payback cash and then discounted at the rate to arrive the value of the firm. Right, so let's move on to the market approach. Market approach is very simplified version to arrive the market value of a business. We discussed there are mainly two types of organizations. One, you have a readily available market price. The other one, the firm do not have a readily available market price. So when a firm do not have a market price, how are we going to value? And when the firms have a market price, how are you going to value? So if they have a market price, we have something called market capitalization. So it's very straightforward. What you need to do is get the market price per share. In your case, you need to get a snapshot of what you take on the particular day, put it into your report and refer it. And you need to find the number of shares they have issued. You can find it, go to the annual report. In the shareholders funds, you can find the ordinary share numbers that they have issued, not the registered number but the number of shares they have issued, so that you can arrive the market capitalization. If the firm do not have a market price, this is where we are applying the price earning ratio method. So when it comes to price earning ratio, we have mainly two types of ratios. That is perspective, the historical PE and the prospective PE, which I want you to calculate in your report. So in the historical PE, what we simply do is we take the current market price and divide by the last year's earnings per share or the latest earnings per share and calculate the PE ratio. Based on that, I have given a list of firms where they have. So it's very straightforward, and I want you to apply for your assignment as well. And then we are going to the prospective PE, where we take the current market price in 1 year's time, the earnings per share in 1 year's time, and use the prospective PE ratio to arrive your figure. Now keep in mind, when you have a market price, still you can calculate this. When you have a readily available market price, what you do is you take the market price as a benchmark and try to use this formula to calculate your prospective. Based on your prospective PE, what's your value? So what you need to do is you take the earnings per share in a historical basis, if existing earnings per share. For a prospective PE, you take the next year's earnings per share and calculate the prospective PE. So the same thing, we can use this formula to arrive. So this is the payout ratio, D1 divided by E1. In other words, this is the payout ratio. KE you need to find, growth rate you have to find. You can calculate the prospective PE. So this is some of the questions that I have taken you through. Very simply, you need to keep in mind when the payout ratio changing, how it will affect your overall prospective PE. When the growth rate is changing, how it will affect, we'll have showcase in this calculation. And you need to keep in mind when the growth rate is, now here it's 6%, so you get a KE, the PE of 6, but when it has gone up to 8, you have seen the PE has gone to 12. Similarly, if it is reducing and on the same time when the KE is increasing, you will find a PE of 4. So these are some of the questions that we applied, and we can even apply the disk table to arrive the same answers. And what is the meaning of this and what is the usage of this? So when you have these P ratios, this is used to arrive the IPO prices of the companies today. So what you do is you take the last year's earnings and get the historical PE, the price earning ratio of the industry or your main competitor, and try to arrive your expected market price. You have to be very careful. This current market price means your expected market price. So you can use your existing market price, and also you can calculate the expected market price based on the historical PE, and then you can compare and you can discuss. In other words, let's assume if the commercial bank expected PE ratio based on your PE ratio, if your expected price is 120 rupees, in the market it's just 100 rupees. Let's assume the scenario hypothetically. Your expected PE is based on that 120 rupees, but your existing market price in the stock exchange is 100, which means there is a chance this price to increase in the future. So if you are an investor, you need to keep your share. Same time, if you are a potential investor, you need to think of buying this share, because the tendency is the price to be increased, the confidence to go up. On the same time, if your prospective PE, based on your prospective PE or your historical PE, will give you a value of 140, whereas your current price is already 200. That means such shares you call overpriced. Overpriced means your existing share price is higher than your expected price. So this is not recommended to buy, because at a given time it can drop to this, or it will be dropped. So if the tendency is to drop, if it is already overvalued, as a potential investor it is dangerous to buy such shares. So you can do this evaluation also at your analysis or your assignment, which will be rewarded, because it's a good discussion that you can take it forward. Fine. And then you can do this calculation as a practice, which I think I have the answers in my previous videos. So based on that, we can arrive an IPO, which you have shown it here. Here we don't know your expected price, but we know your earnings per share and the market PE. Based on that, you arrive the expected share price as 140. So it's easy to justify. In IPO we use this, but we have some weaknesses of this model. The main weakness is when the market price, the evaluation of PE is sometimes difficult to justify, so therefore we have a problem. But even the market price, when you have a readily available price, it's easy to calculate, but the problem is sometimes the market is also changing frequently, so you cannot really take a decision when the prices are fluctuating. So that's the main weakness of the market. So overall, this is what we discussed. We have three main approaches. Each approach has its advantages and disadvantages. So when you are discussing, I want you to analyze all of them, and then you need to take a decision. It would be great if you can recommend for a potential investor whether your firm is good to invest, or are you recommending not to invest. So that conclusion will really add value for your report. So with that, I would conclude the presentation. Why I decided to do this revision, because it will be helpful for your assignment as well. And we will be having one more session, and that session I will explain towards the end of your semester. I will recap all the acquisition and mergers with some more calculations, and so for your exam purpose, and I'll be discussing some mock questions on that session, mainly for business valuation and mergers and acquisitions. Thank you.